see why it needs to be recorded because it's much too much information. Okay, I'm going to get going here and okay, so we're going to get started. Thank you all for joining us on this Thursday evening. We have a lot of information to cover. For now, if you guys could just mute yourself, and if you have any questions, just unmute yourself. But we're going to get started over here. And I'm going to forego my one joke that I tell people. I'll probably do that at my next seminar, but we'll just hold that off. I'll just tell you that it starts with a guy walks into a bar, and I'll just tease you with that. Um, and this is going to be covering a lot of information. And, basically, there's some people on this call, like there are throughout America, some people love, Trump, and some people, can't stand him. But, regardless of your view of him, he's the president, and there's going to be a lot of policies he's going to be implementing in the next, probably 100 days. He's going to try to do a lot of this stuff. So we have to be aware of what's going on with that, and try to see, how to react to that. So this is what I've done is I've kind of culled, information from, you'll see there's slides from JP Morgan, there's slides from Fidelity, from Goldman Sachs, from like 7 or 8 different places. And, Kestra has some, my broker dealer. And what we're trying to do here is just to kind of figure out, what the market is expecting now and, what might happen, with some of these policies he might be implementing. So the basic, things that he's talking about doing as with regards to trade, and they're basically saying they'd increase. Here's the base case: they're saying the new administration enacts a 20% average increase in effective tariff rates on China, increases tariffs on autos from EU and Mexico, and a 3.4% increase in the effective tax rate. That's the base case, and that's why the market's been kind of like okay so far with things. Now, the risk case they're saying here is that they go and they increase the effective tax rate by 10% on all imports, and revoke, the relations with China. So we'll talk about that later on because I go into these things in greater detail. This is like the summary of what we have over here. So that's one of the policies that Trump is talking about doing with trade. He's talking about tariffs, and we'll talk about that later about the implications of that. Then, in regards to immigration, he's talking about, potentially like having 11 million people leaving the country. But the base case right now is that just we slow immigration down to 750,000 a year, and we'll have increased funding for stopping the closing the borders and tighter law enforcement. The risk case is we actually take the people, over 2 million people out of this country. So we'll talk about that in a minute as well. And then in regards to the fiscal policy, the Republicans are in power, so they can pretty much do what they want with a lot of these different things. And, it's pretty much expected that they are going to enact, there were tax cuts that are expiring at the end of 2025. And it's pretty clear that, they have the votes to go and extend that going forward. And we'll talk about the implications of that. They might have to negotiate. There's a state and local tax deduction that there's out there. They might expand that as well. And there's also, when Trump was on the campaign trail, he talked about excluding overtime and tips. He's also talking about potentially, not taxing Social Security. They're also talking about potentially lower corporate tax rate for domestic manufacturers to 15%, and allowing the Affordable Care Act subsidies to expire, and trying to limit some of the green subsidies that are out there as well. So these are some of the things that the Republicans are talking about that we'll go through in greater detail. And I might have another seminar later on down the road that, once these things get a little bit clearer, we'll talk about these things as well. Then, in regards to regulation, the Republicans are focusing on three key areas. Antitrust, they're probably going to ease that slightly, but they'll probably keep on going after tech. And energy, it's going to be easier to approve new energy projects, and we'll talk about the implications of that. And the liquefied natural gas exports, that's something that is an area that's probably going to expand. And they're also going to ease the regulatory burden on consumer financial firms. So those are some things that are planning to be done, and we'll talk about these things in greater depth. So when we look at this, what this all means is that in absolute terms, we're going to still have solid growth. And inflation, this is really what we'll talk about later on, that the Fed is trying to target getting inflation down to 2%, and that's proven to be difficult. In that last leg, we're probably like close to 2.7% now, and that's what the big debate is. We'll talk about that later as to what's going on with that. And the tight labor markets is largely rebalanced. And basically, there's people who are still looking for jobs, and there's people seeking jobs, but it's not like this dramatic, shortage of workers that we had before. And then, the Fed is expected to lower rates going forward. Probably not in the immediate future. I think they're going to stop doing that for now. But later on in the year, they're talking about lowering rates, and maybe two more times is what I'm reading about that then too. And then we're going to get large policies in regards to trade, immigration, tax, and regulations, and then we also have to. There's a balancing act which we'll talk about. Some of the things the Republicans are talking about doing could have an impact on the deficit, so we'll have to see what that's all about. Now, again, I realize that this is an incredible amount of information that we have over here, and that every one of these slides we can probably spend an hour on, and that's why this call is being recorded. So if anybody wants to, in a week or so, this should be on our website. Any one of these slides you can study in greater depth here then. But we're going to move along here. As far as what this all means, as far as an economic dashboard, what this means is that monetary policy is, favorable. It looks like the Fed is going to reduce rates a little bit more. Manufacturing, it's kind of like in the middle over there then too. The consumers are actually relatively healthy. Housing, that's where it's not doing all that great because I think that the higher mortgage rates and the prices is making it difficult for people to go buy houses. And the unemployment rate is increased. However, jobs are plentiful relative to historic levels. So that's the basic economic dashboard we have over here then too. Now this is a slide from Fidelity showing what they think the forecast is, and they think what we're going to have is resilience with slowing growth and sticky inflation. And this is what they say that you should invest in quality growth, economically sensitive value and small caps, and not have too much going out too much as far as in bond duration, and they like real estate with that then too. So this is what they think you should invest in. Um, this is what Goldman Sachs thinks right now. They think that they can beat the market by selectively picking stocks and international equities. They think that the comparison they have there to the U.S. equities is actually favorable. But again, there's a lot of uncertainty with regards to what Trump might be doing with tariffs and things like that. So there's some risk over there then too. Municipal bonds, actually, if you're living in a state where there's where you have higher tax rates, municipal bonds are actually looking fairly attractive. And small caps, which are the smaller type stocks out there, those are things that actually, do look attractive, but actually we'll talk later about my favorite areas, not large caps or small caps. It's mid caps. And we have some investments in that I think make a lot of sense. Because I think that the small caps, even though there's potentially greater growth in there, they also could be impacted if interest rates are forced to go up a little bit. Then with regards to liquid alternatives, there's a lot of things you can do over there. As companies are staying private longer, and there's a lot of private ownership and things, and that's where there's a lot of things that people can do there with things like private equity that we'll be talking about later on down the road, and also pre-IPO type investments. So, and I realize this is a whole ton of information, and I'm going to be talking very quickly. But again, this is all going to be recorded. If anybody has any questions, we can answer them, but we're going to just move on from here. Now, regards to Trump's tariffs over here, this is his baseline, what he's talking about, a 10% baseline tariff on all imports, a 60% tariff on all Chinese imports, 100% tariffs on all Chinese Mexican cars, allow for, a lot of these, the NAFTA type things to expire. Now, that's what he's proposing. What's interesting is, and if you look at what you're looking at this historically, what he's talking about doing, like these huge tariff rates that they had back in the Great Depression, which didn't help the Depression. This is what he's proposing, like historically right now, it's a huge, huge increase in tariffs. So that's what the relative scope of what he's providing, what he's talking about doing over here. But what's interesting is, and this is, and this is what the big debate is, the tariffs that he's enacting, what will they do? I mean, he's talking about these tariffs being a source of revenue, which will enable them to support the tax cuts. So we'll be talking about in a few minutes. But those potentially, if they have tariffs and then other countries enact tariffs, then that could actually slow growth a little bit too. So these are slides that people can study at their leisure. Now, with regards to stricter immigration policies, this is talking about the deportations they might have over here. And, with these type of things, with 1 million deportations, what might happen ultimately by 2028, there'll be 3 million workers out of the workforce. And if he does what he's talking about, doing the greater scale of it, it could be 7 million workers. And these type of things would have an impact on consumption and also on tax revenue because people don't realize this, but the people who are paying in the immigrants and things like that, they're actually paying into Social Security, and there's really no account there for them. So those are some things that they're looking at over there then too. Now, with regards to federal finances, this is what the consumers are doing well, but the federal government is not. As far as the deficit is rather large right now. It's historically rather large considering we're not really at war, and this is a concern. And then they talk about we'll see in a minute about if they extend a lot of these tax cuts, it's projected that the deficit will get even greater from there then too. So this is just something to keep an eye on. And this is actually looking at the tax cuts, the impact of the deficit, and it's showing, the rather, the impact of this. And, it's increasing that. And, they are talking about, with the tax cuts they're doing, they're talking about, cutting a lot from the budget and enacting all these things. But, when you look at like the budget, what we have right now, really only like 25% of it is available for cuts because you have things like interest on the debt and Social Security and Medicare and defense spending, which I don't think they'll cut back in defense spending. There's really not that much discretionary spending to cut, but that remains to be seen as to what they'll be cutting and the impact of the deficit that'll have there then too. Now, as far as manufacturing activity, that's still struggling a little bit with to accelerate. So that's something they'll look at that to see whether they can. Trump is trying to increase manufacturing in the United States, and that's one of the reasons why he's enacting those tariffs. Now, as far as the election impact over here, we're looking at the basket of type of things, and it kind of shows you that Bitcoin and Republican equity basket consists of equities, so the benefit. The Republican basket includes financials, energy, and small businesses, and it shows you what that did after election day and how much it went up from that then too. So Bitcoin especially went up a lot. And then it shows you what's interesting is the semiconductor stocks, they actually didn't perform very well. And that's because over 50% of their sales actually come from overseas, and they would be impacted by by tariffs then. So kind of like a view of what different sectors might do. We'll look at that in greater depth. Now, as far as valuations go, there's a lot going on with regards to valuations. And basically, the stock market right now is very expensive when you look at on all these different ratios like price earnings and dividend yield and price to book and price cash flow and comparing it to bonds. They're at historical, highs, and it's like a one standard deviation difference between, what's normal. So that's a concern that the stock market is kind of expensive, and that's why I would be, somewhat cautious. We'll talk later. Well, actually, I can tell you now. There's a forecast that people have. I have this forecast from First Trust, which talks about, what the 20 financial places think about, and what their forecast is for the future. And it ranges from a negative 11% by First Trust to a 20.7% by Oppenheimer. So it's interesting. There's a huge range of 20 different firms. And that's, that just shows you the uncertainty with regards to a lot of these different things out here. And again, the valuations here are above average. So you have to be concerned about that and be somewhat cautious. We've had 2 really good years in the market where the market's made really good returns. So we just have to be a little bit cautious, I think. And when we look at this, again, compared to all these different metrics, the stock market is expensive, dividend yields are low, compared to, treasury yields, which are fairly high. So there's something to think about. But the concern here is like, should you not invest in the market? This is a slide which is very interesting. It shows you even though the stock market is high, we've had relative, highs in the market, it still would mean that you should invest in the market. So I think you want to be somewhat cautious and with it, but you still want to invest in the market over time. And this is a long-term slide, not that people are alive from 1900 here, but it kind of shows you that over a long period of time, the stock market does do well. It had this period from 2000 to 2010 where it was relatively stagnant, but in general, the market, throughout, we have a longer term time horizon, the stock market does do well. Um, this is something which kind of shows you why it's important to rebalance. It kind of shows you if you had a 60% equity, 40% bond portfolio, that now that same portfolio, if you didn't rebalance it, would be only 27% in bonds. So it just shows you that, the overall growth of large cap growth has led to this, overbalancing of that particular area over there then too. So just something to keep in mind. Now, with regards to small caps, and those are the smaller companies, and mid caps, which are the medium-sized companies, and large caps, it just shows you that the large caps have a lot of money in information technology, and those have really done well in the last few years, and that's why they've outperformed. And you can see like the small caps are largely in things like industrials and healthcare and financials. So what I find interesting here is it shows you like the percentage of unprofitable companies in small caps and mid caps and things like that. So that's why it's important. There, I have this one investment that they did this study. They said, what would be the one thing you can do to beat the market over a long period of time? And that one thing that you can do is invest in profitable companies, which seems kind of intuitive, but that's what this is kind of showing. There's large percentages of unprofitable companies that people are investing in right now. But it shows you the earnings growth you could potentially have in these small caps is rather large. So it's something to think about. And this shows you that the corporate earnings are actually rebounding. It's actually gone up a lot. And it shows you they're expecting earnings to grow by 10%. And small cap earnings are expected to grow, to a large extent in the second quarter of 2025. Now, when you look at it from a valuation perspective, this kind of shows you that every one of these, asset classes from large cap, mid cap, and small cap are relatively expensive, except maybe when you look at and compare it to small cap value. So one thing that's not really expensive. And this kind of shows you historically that large caps have done, incredibly well. If you would have, had an equally weighted type performance, you would have actually underperformed, having all those magnificent seven stocks, which we'll talk about in a minute. But that might change, and we'll see about that in a minute. Now, as far as the corporations, what they're doing, where their earnings are growing from, it's largely from margins, which is basically the difference between their profits minus their expenses. They're making decent profits and they're not paying as much out to their workers and things like that. So their margins have actually increased a lot, which is leading to the revenue increases. And that is basically how they're getting their profits. Now, when you look at the stock market now, even though it's relatively expensive, it kind of shows you here that on a 1 year basis, it's okay to invest in the stock market when it's expensive. But when you look at over 5 year periods of times, you don't really do generally as well when you're investing in the stock market, which is at an all-time high. As far as value versus growth, growth stocks have actually in the last several years have done a lot better, and it shows you like what they're investing in. It's interesting. I find that they have a large percentage, even though these tech type companies have a large percentage in cash, but they're also investing a lot in research and development. So, which is, that's what they're doing to grow their portfolios then too. And this kind of shows you, this is a slide which people can study later. It shows you like when growth would do well and when value would do well. And right now, in the area where right now where interest rates are going to be somewhere between 3 to 5%, it shows you that value, you want to have some value in your portfolio as well, and not just have the growth stocks. Now this is the big thing that actually happened in the last week or so. There's companies have been spending a large amount on investing in data centers and things like that. And all these companies, the Magnificent Seven, the Alphabets, the Amazons, the Metas, and Microsofts, the Oracles, are building these huge data centers to build off these artificial intelligence type things. And it's basically, that's what's happened. And then out of nowhere, This Chinese company called DeepSeek came out and they said that we can do it for a fraction of the cost. And a lot of people I've talked to, from people from BlackRock and other places like that, they don't necessarily believe that their numbers are real. But the concept is that what they're trying to do with all this huge spending over here is keep on throwing a lot of money at the problem. And I guess the analogy which I heard is that they're trying to get us to get some orange juice for you to get you more and more oranges. But what the Chinese companies has done is to try to find a way to squeeze the orange a little bit more efficiently. And if they can do that, and they have these things in their chips which are actually able to do things more efficiently, who knows? I mean, so the question is whether all these companies are kind of like spending more than they really should over here then too for that then. So it's just something that we have to keep in mind. And again, the Magnificent Seven stocks, the Nvidias of the world, they are relatively, they've done wonderfully, and their earnings, the profit margins have been great, and their earnings have been great. But you can see, like earlier in 2024, they had tremendous earnings compared to everything else. But it's starting, the other companies are starting to join the party, so to speak. So I think it does make sense to have, something other than the Magnificent Seven stocks in the portfolio. So it's just something to keep in mind. And as far as the valuations here, this kind of shows you that the top 10 stocks in the S&P 500 are, kind of way overvalued compared to the remaining stocks, which are really, somewhat overvalued, but not really, not nearly as much as that. And this is kind of interesting. It shows you like those top 10 stocks are largely are 40% of the S&P 500, which to me is really incredible that you think when you're buying the S&P 500, you're buying 500 stocks, but what you don't realize is that 10 of those stocks are going to give you 40% of the performance. So it's just something that you want to really look at, and it's something to keep in mind. And I think that the Magnificent Seven earnings here are, there you would expect those to be challenged in 2025. Um, they're not growing quite as much, and the other companies are starting to catch up with them there then too.
Hey, Stephen, what do you consider overvalue? What's the number?
It's just looking at this. This is showing you the overvalue, the top 10. It's showing
Yeah.
compared to the average since 1996. It's showing you, it's 29.6 price earnings ratio versus 20.5. So it's showing you it's 144% overvalued. Does that make sense?
Okay. Yeah, yeah. Yeah.
Anybody else has any questions, just feel free to jump in, because otherwise it's me just sitting in a room by myself, just talking to myself. So that's fine. Okay. So here, this is the other thing that's really important. And we have some people on this call who are from NextEra Energy. And this is what they talk about electricity consumption, where it shows you, which I found interesting going back in time. Like this shows you that the tremendous growth they have in commercial, which is basically building these data centers and things like that. This shows you the data center demand is expected to grow, to huge amounts going forward. Also, the number of electric vehicles is expected to grow. Now this could have an impact with some of the things that Trump and Musk are talking about, getting rid of some of the subsidies they have on cars. But in general, this is why a lot of the utility stocks have actually had some decent growth in the last year or so. But there's some challenges with that then too, and there's some questions. Like we have some company that's investing in data centers and helping the real estate with respect to that. So I still think it's an interesting area, but you do have that, out of left field, this DeepSeek came out and, maybe questioning whether they need to build as many data centers. Now, as far as the AI adoption, this is why they're spending all this money, because they're expected to get great productivity with this and later on down the road. And artificial intelligence appears to be broadening. A lot of companies are using artificial intelligence in healthcare, data security, transportation, automotive, agriculture, social media, education, software development, and financial services. So the AI is not just for the technology companies. They're finding ways to do things a lot more efficiently. So this is the cool part about it, where we're actually going to get more production and increases in GDP, gross domestic product, as a result of this. This just shows businesses using artificial intelligence to produce goods and services, doing it with information, professional and technical. It's showing all the different sectors out there that they're doing this in. So there's a huge amount of growth here. Now, this is the part that that is important, that you want to have your economy growing, and you want to have growth in the real output per worker, which the artificial intelligence thing will help, but you still need workers. So that's the concern, is that if we have dramatic taking out of the workers in this country, you know it's we're not going to have as much growth. We just can't, and that's one of the concerns when you look at like the Japans of the world and the Chinas of the world with their one child policy. It's like a demographic time bomb. You actually need workers to support the older people getting their Social Security. So that's why the growth here is going to be somewhat limited if we don't have enough workers in this country. So um, when we look at this, the consumer is really the key to the economy. They're about 70% of the overall gross domestic product is consumers spending money. And consumers here, they're a little pessimistic about the economy. And they're this is actually a helpful thing. They're somewhat pessimistic with respect to that. When the consumers are very confident, it's not necessarily a great time to invest, but now they're a little pessimistic, which is actually kind of helpful. Um, with regards to retail spending, they're still spending money like it's going out of style, which is actually very helpful. And their savings rates is kind of low. So, they're starting to, we'll see later, they're starting to increase the balances they have on their credit cards and things. And, they're still spending like it's going out of style. And this is showing the delinquencies, like I said, in credit cards are actually increasing, and the household debt to service ratio is going up a little bit over here. But that being said, they're actually in great shape, because they've had such great gains in the stock market and their homes value increasing. Their net worth is actually increasing, so they could it's a kind of support some more spending over here then too. So when we look at this with regards to components of the gross domestic product, consumption again is the thing that's going up a lot, and it's basically government spending, which they're talking about decreasing. It doesn't have as much of an impact on the overall, the overall GDP growth over here then too. I just kept this slide in here to kind of show you like the world that people look at. And again, like America, there's probably people on this call who support the Republicans, and some people support the Democrats. But it kind of shows you like, your view of the world is based upon who's in power. So the Republicans, now that Trump is in office, think that everything's great, and the Democrats think it's terrible, and vice versa when Biden was in power then too. So kind of is an interesting slide. Now, with regards to the returns and valuations by sector, this is a chart which people can study for like 10 hours. But the gist of it is that there's very few sectors in here that are undervalued. Really, it's just when you look at it like energy and utilities, financials and real estate, they're like fairly valued. Everything else is actually fairly expensive. The other thing that you want to look at is uh, the percentage of foreign sales here. So it's showing you that the technology sector, 56% of it is foreign sales, and that's why they would be impacted a lot by this potential increase in tariffs and things like that. So there's a lot on this slide. I know it's a super busy slide, but this kind of shows you like the certain areas where it might make sense to invest. Now, with regards to this is another busy chart, and again, I'm going to go through. I'm going through a lot of information now, and I realize I'm talking really fast, and I realize it's a whole ton of information that people really can't process it this fast. But it kind of shows you that the seminar which I'll be doing in the next 2 weeks, which is actually what do you do with all this information, and that's the part that I think is probably really more helpful for people. But this kind of shows you that the goal here is to have a balanced portfolio and to kind of like, not get all the highs of the market, but also not experience the lows. That's why it's important to have, like your 60-40 model over there then too. This is also showing you the CD rates and other investment opportunities. Yes, people can invest in CDs now and get decent returns, but this shows you, after the stock market, after the Fed starts cutting rates, what do you make more money? And it shows you that you make more money by investing in the stock market or investing in a 60-40 portfolio. So again, it's probably doesn't make sense to keep your money in CDs and things like that, because you'll miss out on a lot of these opportunities. Now, this slide is, again, a very busy slide, but I think it's really important. The goal here and the goal in investing is to try to get the maximum amount of returns for the least amount of risk. And what you want to do here is you want to add in things like hedge funds and direct lending and venture capital and private equity, and they all have different risk characteristics. But the goal is here, and we'll talk about this at the next seminar I'll do. If you mix some of these things in here, you end up getting greater returns and lower risk, and that's why I think that makes sense. Now, the other big thing that we need to talk about is changing interest rates, and that's what the market is focused on. What is the Federal Reserve going to do? And right now, the forecast is that they're going to, and this is what the Fed is saying and what their expectations are, and this is what the market's expecting, and they're pretty much in sync for the near-term future. But then the market is expecting rates to be staying higher, while the Fed is saying they're going to reduce rates lower, and that's where there's some kind of mismatch over there then too. This is the concern that the Fed has, is that they're trying to get down to 2% inflation, and that's going to be difficult. There are certain things we'll look at that, owner equivalent rent, which is like 30-40% of this inflation number, that's actually coming down. But there's things that you can look at, and it might be difficult to get down the rates. So the question is, what are they going to do? Are they going to keep on reducing rates, or are they going to keep it where it is? And there's some people think there might be like a wait and see attitude to see what the impact, whether Trump will have tariffs and what the impact of that might be. Um, so this is kind of showing you the different policy paths of different higher inflation and terminal rates and things like that. Um, as far as the fixed income yield is showing right now, they're expected to get 4.97% yield. You would expect to get in the next 5 years about a 5% rate of return. So that's actually a pretty decent rate of return. Now, with regards to the fixed income views, this is looking at this, and it's basically saying what they're expecting. They might be able to, bonds actually could do okay, and they expect that interest rates and the long-term rates should go up a little bit as far as that goes. And they're expecting, think companies with credit, those actually should do okay. And actually, they're looking at a world where the Fed is more focused on growth and inflation risk. But they're expecting around the world for a lot of the countries to start to cut their rates. And municipal bonds, even though taxes could go down, they're expected to do okay as well. And again, when you look at this from a perspective of yield, this shows you that the yield and right now, the interest you're getting on these bonds is historically fairly high. So you're actually getting some protection from getting that yield in the event there's a reversal in the market. And this kind of shows you all the different areas of the market, and you're actually getting a decent rate of return for that. So the bonds are finally giving you some kind of income. Like a couple of years ago, I really had bonds. You had to have them and hold your nose to have them. They were paying you like a 1 or 2% rate of return. It was really hard to justify holding them. But now getting 4 to 6%, they actually make sense to have a little bit more bonds in your portfolio. Now, what's interesting is the Fed can say what they want interest rates to be, but the market will kind of tell them. So right now, like the Fed decreased their rates 50 basis points, but the 10-year Treasury yield began to rise, which meant that the bond market said, we don't think this is all going to work out. And the Republican victory, they were talking about all these tax cuts and all these other things they were going to spend money on, and the bond market said, no, we think rates will be higher, and that's what the balance should be like. If they do a lot of these tax cuts and things like that, and tariffs and things like that, that could be inflationary. So the bond market might not agree. The people buying these things might say, we want to get a greater rate of return. So it's a question as to what's going to happen. And that's really what the balancing act is right now with respect to that. Now, the thing that people don't really know about that's really going on behind the scenes, which to me is, this is really interesting, that people don't realize, is that the Federal Reserve not only reduced rates close to zero back in all these different periods in 2008, they kept on buying bonds, and they kept on doing that artificially to keep interest rates lower by keep on buying bonds. Now, they did that for a period of time. They increased the balance sheet tremendously from like a 1.4 trillion to ultimately huge amounts of that then too to like 8 trillion. And what's going on from there now is they're finally starting to reduce the amount of bonds that are out there then, which is taking some cash out of the system, which should ultimately, that's something that would, keep rates a little bit higher. So that's something that's going on behind the scenes that a lot of people don't know about. Now, with regards to bonds, bonds usually provide a lot of stability to people's portfolios. But what's really interesting is when you look back to 2022, when interest rates went up dramatically, that bonds really didn't provide as much protection at that point in time. But right now, with interest rates a little bit higher, I think that's not necessarily the case. Now, with respect to interest rates and inflation, this kind of shows you here that, the nominal yields now are fairly high, and the real yields are pretty decent and compared to inflation. So you're getting a decent return from your bonds compared to inflation. Now, when you look at this historically, I like to keep this slide in here because it shows you, we had this wonderful time. This is actually a really horrible time for bonds from 1958 to 1981 when interest rates went to 16%. You actually lost money in bonds, and you also, you didn't really do well, after inflation. But holding bonds from 1981 down to today, you actually would have made a lot more money compared to, and you actually, you would have done really well after inflation with that then too. Now, with core CPI, this is the thing that the Fed is really looking at. They're looking at, what's increased in regards to food and energy. And, right now, we're trying to get this number, this core inflation number down lower. And that's what the Fed is really looking at to see whether they can reduce rates. Now, when you look at the components of inflation, this to me is kind of interesting when they look at what's in here, like things like energy and things like that have actually gone down. But one of the stubborn things that's in there is auto insurance, which I find interesting. And that's because the price of fixing cars, and a lot of cars are being totaled. A lot of those things are, in there. And, some of the things that really should be decreasing would be, because a large component of this is generally shelter. That's actually going down a little bit, but it's going down a little bit slower. So these are the type of components that the Fed is looking at. The Fed is also looking at wage growth, which, it's actually bad for inflation when workers get a raise, but it's good for the workers who get a raise. So right now the workers are actually getting decent raises with regards to that. Now, with regards to inflation, this is where you're looking at all the different places where inflation is going up over here then too. And in general, it's going in the right direction in most places, which is helpful for the Fed continuing to reduce rates. But again, it's something they have to be very, very, they call it being data dependent, which means they're looking at the data every day to determine what to do. Now, one of the other things that Trump is talking about doing is they call it drill baby drill. He wants to keep on, right now we actually have an all-time high in like oil production, and natural gas production is actually right up there as well. But he's wants to increase production, and some of that production with natural gas actually could be exported here. Now, the issue that the oil companies are actually somewhat, in the past, it's kind of been this simple thing that when oil companies produce a lot of oil, then the prices will go down. That's the simple supply and demand. But right now, the oil companies are being a little more sensitive to only drill on things where they feel like they'll be getting a good long-term, projection on their returns. So it's really, we don't know what's going to happen with the price of oil. There's also, one of the things, the positive things about Trump is like, I would expect that the war in Ukraine would end. I think that there's, and then you have the potential of Russian oil coming on the market, which also could lower prices. We also have the war in the Middle East, which, right now it seems like is okay. So there's all kinds of, the price that we're looking at over here is not necessarily dependent upon what the U.S. is doing. It's an international market. What's interesting is we've been producing so much oil compared to the rest of the world, which is actually, we're the ones who are, making up for a lot of this shortage that's going on in the world. It shows you, as time goes on. So it's something that you really want to look at. If we increase production a lot, what would the impact be? Because if the prices go down dramatically, that wouldn't help the oil company. So I'm not really quite sure whether it makes sense to invest in oil companies. Right now, the thing that I would like to invest in more are the pipeline companies that it could be moving this production. So there are interesting investments in that where they're paying 6 to 8% yields, and you're owning the pipelines which are sending the natural gas and the oil for that then too. So it's kind of an interesting time with that then too. Now, um, with respect to the labor supply, there's a lot going here with regards to non-payroll gains. Right now, the labor supply is increasing. Now, as far as the projections, like it shows a huge immigration impact of a lot of people coming to this country, but as time goes on and that dissipates, the population is going to get, and this is kind of interesting when they're looking at the birth minus deaths. It shows you that that's actually going to, ultimately, take people out of this economy. And again, we need people to replace all these people that are dying in the economy and leaving the workforce. So that's part of it then too. And the labor participation, I found this interesting too. It shows you that all the 55 and over people are leaving, but the 25 to 54 females are joining the market. So that's kind of interesting. Now the labor market is starting to soften a little bit, and few workers are quitting their jobs, and they're having a little more anxiety with regards to their jobs. Now, in regards to what the Fed is expected to do right now, the Fed funds rate is actually like 4.3% in December, and they're expecting it to go down to 4.1% in 2025. So it's something to keep an eye on. And small business hiring is slowing a little bit because I guess there aren't as many job openings as before. Um, and with regards to corporate bonds and things like that, there's a few more bankruptcies out in corporations, and the spreads are actually kind of interesting right now. They've declined a little bit. So there could be some potential stress if there is a negative uh, market event for that then too. And it shows you when the market returns around the start of Fed cutting cycles. It kind of shows you what would happen there. Um, the Fed generally does well, and 10-year bonds actually do well when they cut rates as well. Now, with regards to fixed income dynamics, this kind of shows you it's not just one type of bond out there. There's all kinds of different bonds out there, and some of them have a greater impact with interest rates rising and falling. So it's just something that we have to keep in mind. With regards to municipal finance, there's a lot of information here. Basically it shows you that sometimes if you're in a high tax bracket, it makes sense to buy municipal bonds, and states are actually in great shape as far as their balance sheets. They're doing really well as far as that goes. There's a little bit less risk in states than there has been in the past. So now what we're going to do is we're going to look internationally. We're going to look at these different things, and we're almost winding down here. There aren't that many more slides left. It's basically showing that the international valuations are much more attractive than in the U.S., and the difference in dividend yields is actually much more attractive outside the United States. But there's a lot more risk with regards to what might happen with regards to tariffs and things like that. And the last 10 years, investing internationally has pretty much been a waste of time because large cap growth in the U.S. has actually done really well. So it's just something to keep in mind. There's better valuations, there's better dividends outside the United States. So I think having a balanced approach actually does make some sense. Now, this is actually an important slide because one of the things about investing internationally is that if the dollar appreciates, then you don't do as well in your international investments. And that's the whole thing about this, the tariffs and things like that, is that they could potentially increase the tariffs, but then if the currencies of these countries decrease, then their goods would actually not go up in price. So I was reading about some of the concepts behind the Trump administration about what they're planning on doing with tariffs, and that's the big thing about the tariffs as to whether they're going to happen or not. The question is, with regards to tariffs, is the Trump administration going to use it as a negotiating tool, which I think that's what the market is right now expecting, or are they going to use it as a way to raise a lot of revenue, which means that they actually will be implemented? And if they do that, that could have an impact, and that might be inflationary. So that remains to be seen with regards to that. As far as global economic activity, the general overall markets around the world are doing okay-ish. But the U.S. is actually still the strongest country out there then too. And it just shows you the valuations. and most of the world is going to be cutting rates, and the question is whether the U.S. is going to be cutting interest rates. Um, and it shows you the different places to invest there then too. And as regards to different places to invest, this is Goldman Sachs' slide, which shows you, where they think there's greater growth going forward. And again, this is something which people can study at their own leisure. This kind of shows you that the average tariff rates on U.S. goods imports from China, it increased dramatically. Um, and various places you could do. Now, one of the things that a lot of countries did when they weren't going to China, because there were a lot of supply chain issues and things like that, where it took a long time to get their things, and China wasn't sending these things. So a lot of companies made the decision to do they call it a nearshoring. So with that, they tried to get they're trying to invest in places like Mexico and places outside. Vietnam also is outside of China, so they tried to go to those places. But now there's a lot of uncertainty with regards to whether that strategy makes sense if the Trump administration is going to impose tariffs on places like Mexico, because then that kind of defeats the purpose of going to those places. So it's kind of like the world is in a little bit of a holding pattern right now, trying to see what might happen. There's places like India where they were getting a lot of manufacturing in there then too. So the question is what's going to happen, because we don't really know what the rules are in the game right now. And when you look at this, um, the U.S. is currently a huge percentage of the global market capitalization. So, having a little exposure in some of these other places could make some sense. So, with regards to emerging markets, the valuations there are actually, kind of compelling. And again, when you look at it over a longer period of time, it really does make sense to have, invest in emerging markets because there's greater growth. The middle class is increasing, and there's a lot more people in there. And generally, when all those younger middle class people, they join the middle class, they will spend more money. So there's, in a 20, 30-year period of time, it would make sense that growth overseas would be greater. But again, we don't really know what the impact of these tariffs is going to be. So there could be some short-term volatility with regards to that. But overall, if you had a longer time horizon, it would make sense to um, invest in emerging markets. So overall, as far as the emerging market, the equity views, the U.S. is continued to probably would do well. Um, but again, it's the problem is you have the high current market valuation and you have market concentration. And they would, you would expect that the overall performance of things like it's not just going to be the Magnificent Seven stocks leading the market. International markets have attractive opportunities, and you really have to look at that. But again, we don't know what's going to happen with regards to tariffs, and we don't know what's going to happen with emerging markets. The same thing. But there's potentially greater growth, but there's also risk with regards to we don't know what's going to happen with what's going on there. And this is talking about China. Again, they have their problems with their debt, a lot of bankruptcies in real estate over there then too, and the demographics that have enough people, and the tariff headwinds they have over there then too. Now, the other thing that's important to look at is private equity. You want to look at things like that. Again, we'll talk about this at a later time, but there's 6 million uh, private companies out there, and everybody's talking about the stock market. The stock market, there's about 4,000 publicly traded companies. So it's really important to have access to those companies as well. So that's something we'll be talking about the middle of February. So if people have questions about that, we can talk about that some more. So, in summary, we're living in a volatile world. Right now, we're kind of in a holding pattern, kind of seeing what's going to happen with regards to these, Trump's policies. But right now the market is expecting, small changes in tariffs, the extension of the corporate, the Tax Cut and Jobs Acts. They're expecting, immigration to, taking some people out of the country, but all the people in the immigrants in this country some of them will remain and continue to do their work. So that's what the market is currently expecting. And then the question is, we don't really know for sure, the impact it's going to have in the U.S. and also the impact it's going to have internationally. But for now, the stock market, the issue is that the stock market is rather high right now. So we're kind of like kind of like priced to perfection right now. That's why I think it's important to diversify people's portfolios and to have some downside protection in their portfolios. So I realized that that was an incredible amount of information I just went over in a very short period of time. But if anybody has any questions, just feel free to ask them.
Hey, Steve,
Yes.
on that screen you're on now, what is where it says APAC ex Japan, 14%? What is APAC?
APAC. I think that's
Asia
just
Pacific. Asia Pacific.
Asia Pacific.
Okay.
So it's basically, there's a lot, every one of these slides, like I apologize in advance because I realize that this is a lot. We just traveled around the world in 45 minutes and went through 80 slides. So it's a lot of information, but the beauty of this is that every one of these slides will be available in a week for everybody and you can study them in greater depth. Um, but again, the key thing here is that a lot of the information here is, I know, overwhelming. That's kind of like my job, is to kind of like look at all this stuff and to kind of figure out what is like the optimal, portfolios that people should have to try to, get the market participation, but also protect against the downside. Um, but the more important presentation we'll be doing is in a couple of weeks. We'll be talking about, what to do, the behavioral finance type things about how people should react to these to reach their goals. Anybody else have any other questions? I can't believe that everybody just doesn't have a question after all I went through. I guess they must have, either they're sleeping or Curtis, do you have a question?
No, it's just a lot of information, Steve.
Yeah, no, I realize that. But
Yeah.
it'll be helpful if if you have any questions, you can ask me about it. And if there's any particular slides, like, when you have them and it's on the, you can study every one of these slides in greater detail. But I'm just trying to give you a flavor for what's going on in the world right now. And I realize it's, a normal way of doing a presentation would be to, tell somebody something once and then repeat it and then summarize it again. And that would be a 5-minute presentation. But I want to give people their money's worth, here. So that's a lot of information. So anybody else?
Yeah, Steve, what changes are you going to make to the models based on this information? Any tweaks to the models that you maintain?
Yeah, I mean, the thing that I think the action items for me is, like, when I studied this thing, like, large caps I think are very expensive and small caps have a fair amount of risk. I think that mid caps, one of the, is something, the medium-sized companies are something that I think it makes sense to maybe have a little bit more in that. And I do think, when we look at, the other asset classes that are out there, I think having things like, people we should look at things like private equity and also, pre-IPO investments, because I think those are poised to do well, especially with a lot of the regulations, regulatory burdens that Trump's going to take down, that a lot of these private companies will be bought out or go public. So those are some things that make some sense. In regards to bonds, I think it's important to, I think you want to take like a barbell approach to bonds. I think short-term bonds are actually an okay place to be. But there's other selective areas where you can invest in bonds as well. And there's I went to this interesting presentation from BlackRock yesterday where they were talking about this alternative investment that actually makes sense as well. So I was gonna maybe add a little bit of those type of things, because right now the market is kind of priced to perfection. You want to have things that will get you some of the upside of the market and protect the downside, because I do think you know, if you want to give the lawyer's answer as to what I think the market's going to do, I think that there's, the possibility the market can go up or down 10%, and that's why a lot of the people on this call have things in those what I call the Reese's peanut butter cups of the world, where those I think make a lot of sense. Those type of things then too. So, but in general, yeah, there's little tweaks I'm making to the model based upon the information we have in this. And again, I realize this is overwhelming amount of information, but that's what I do when every quarter when I get together and I build my model. I'm kind of like figuring out what the outlook is and seeing where to put 1% more in this or 1% less in that one. That's what I'm really doing behind the scenes here.
Steve, I have a question. Regarding the deficit, do you see it to be there's destruction down the road if we don't deal with the deficit? Because the deficit really, rather than 35 trillion, it's more like 100 trillion when you consider the net present value of the future liability for Medicare and Social Security benefits.
Yeah, and I do think that that's a concern. Like when you go back and you look at these forecasts of what the deficit is, like right now we're kind of getting by. The problem we have is that it's okay. The deficit is kind of okay when you have interest rates that are like 1%, but if interest rates are 4 or 5%, then you're paying, I think, what is it, 25-30% is going out just to pay interest on the debt. And if I had a client and they were paying out 30% interest on debt out of their house, that wouldn't make sense. So there is a concern as to what's going to happen with regards to that. And I do think there are some Republicans in Congress who are concerned about this. So some of the things that are being promised, like cutting taxes on Social Security and tips and overtime, and everybody's got their hands out. And it all sounds good. But the question is, who's going to pay for it all? And also, when you think of things like, the Social Security is something which, later on down the road, like right now, we have like this ticking time bomb where Social Security is expected to run out of money. I think in like 2034, they can only pay out like 75% of the benefits. And the thing about it that people don't realize is that there's no real, pot of money out there with your name on it. So it's basically all based upon you know, um, having that money to be paid out. Now, I do think with something like Social Security that, the people who are currently on Social Security or close to Social Security, I don't think that they will cut back their benefits. I think the solution that they'll have is that they will kind of screw the younger people. I think that younger people are going to have to retire later, and I think that that'll be over a gradual period of time. They might do some things with cost of living adjustments. They also might do some things with increasing the tax that you have on your earnings with that then too. But part of what Trump was saying also is that we don't know really for sure, like regards to some of the things they were talking about with regards to raising taxes and things like that, like cutting back on the. I know, Russell, you work as a CPA, like cutting back on enforcement with the IRS would lower tax revenues, which would mean the budget deficit would be even greater. And and that's the concern. Is like when you look at like the Japans of the world, that Japan has much greater debt than they do GDP, and ultimately when you have that situation, it's really hard to grow. So that is a concern about the deficit. Some people are just like, don't worry about it because, and the concern is that most people in Congress, they don't really care about the world 10 years from now. What they care about is the world next year or next, they got elected in 4 years. So that's the concern. It's really hard, when you look and see, what this deficit is, it's, going up from right now, like 100% is kind of sustainable. But to go up here to like 120 or 130%, that gets to be more and more expense you're going to have paying interest expense out, and it gets to be harder to spend money on other things. So that is a concern when you look at this. And, I think that they have to be prudent. I don't think that everybody can have their hands out and can get money. I think that they do have to think about, a balance between, cutting back on spending and also, not not reducing taxes for everybody, because somebody's going to have to pay some taxes to make up for this deficit. And my view is that if you have an opportunity to do things like Roth conversions and things like that, because right now we probably have a 4-year period of time when the Tax Cuts and Jobs Act will be extended. You probably have a period of time when taxes will not go up. I would think that doing a Roth conversion and things like that makes sense because later on down the road, this increasing budget deficit is going to be somebody's going to have to pay for it. So I think it's important to look at things like that now. You have this 4-year runway with Trump still in office. Well, taxes probably will be lower, or at least I think will be the same. It makes sense to maybe look to do Roth conversions to enable yourself to not be the one having to pay these taxes. Does that make sense?
That makes sense. And also the bonds, the treasury bonds may get downgraded, I presume, at some point, if we don't do something about the deficit.
Yeah, and that's where, so one of the things that's really enabling us to print money like it's going out of style is because the dollar is respected around the world. And we have this, AAA credit rating, and because everybody wants to buy treasury bonds, but what's happened, historically, the British, pound was the currency out there, and before that it was, currencies beyond that, and ultimately when you lose that power, then you can't print money because people say no, you can't print money anymore. We won't buy anymore, and if suddenly there's other slides that I don't have in here, it shows you like the percentage of countries that buy the U.S. Treasuries. Like 30–40% of the U.S. Treasuries are bought by foreigners. And if the foreigners say, we want to get paid more, you have to increase the interest rates even more to pay the foreigners. And again, you don't have control over your own finances. So this is a concern going forward. You have to, like, if I had a client and they weren't balancing their budget and they were spending, everything that they were making, they're not going to have enough money for later on down the road. And it's a similar situation for the government as well. Now, the government could grow their way out of this but I think right now it is a concern, and I think there are several Republicans in Congress who are saying or going to say, and that's really where it's not everything that Trump wants to do is just going to be a rubber stamp, because there are some that are saying, hey, we have to be concerned about the deficit. Does that make sense?
Yes, it does. Thank you.
Okay. Anybody else? Okay, so I'm gonna stop the sharing, and I guess we'll look and see who we got left on the call. We got a lot of people here then. Okay, so if nobody doesn't have any questions, I'll give you one more try to ask a question. Other than anybody? Okay. Well, thank you, everybody, and for joining me. And if anybody has any questions they want to ask offline, feel free to share them, to ask me. And again, we'll probably do another seminar in a couple of weeks about the 5 risks of retirement, because I think that one is really the important thing. Because I realize that this is an overwhelming amount of information for everybody, but I thought it was important for people to at least get a flavor for some of the things that are available and out there.
Thank you.
Thank you, everybody. We'll talk to you soon.
Thanks, Stephen.
Thank you. Bye.
Thank you.
Thank you, Stephen.
Okay,
Great
bye-bye.
comment. Bye-bye.
Thank you.
Okay, bye-bye.
And bye, Steve.